Hello, everybody, and thank you for joining us for our November 23 update. Today is November 16th, 2023, a week from Thanksgiving for all of those of you who are planning parties. Better get to it. Again, thanks for joining HCM's update. HCM is an organization of approximately 30 people who specialize in helping our clients build financial independence. We do that through a combination of comprehensive wealth management services, retirement planning, risk-oriented investment management, and of course, tax planning and preparation. So those are all things that we focus on, and I basically wanted to just remind everybody that we have a lot of clients. We also have guests on the line as well. So that's what we do. My name is Mike Hengehold. I am here today with Dan Rinck. Dan is a senior analyst with the firm, and also here with Doug Johnson. Doug is a CFA and a partner with the firm. My name is Mike Hengehold, as I might have said, but we are here today to talk about taxes a little bit because we're coming up on the end of the year, and also with some portfolio and market related thoughts as well. The first thing that I would like to do is sort of begin with the end in mind. So the point of tax planning, the way we approach it at HCM, is maybe a tad different than a typical accounting firm might be. Normally, you would walk in and somebody might help you determine, if your taxes have been paid for the year and if you need to make any payments to catch things up. Our approach is a little different because of the way it blends into our wealth management process. Our goal is to help a family pay the minimum lifetime tax for their family over the course of their lifetime. And so that takes a little bit longer term view. So we have essentially two roles in our tax planning process. The first rule, as I said, is pretty much to focus on paying the minimum tax we can over a lifetime. And rule number two is essentially, don't forget rule number one when you're doing your current year planning. So when you're doing your short-term planning, always make sure that sort of blends into the longer-term goal. And that'll hopefully be pretty clear as we walk through the presentation today. So the first thing I want to do is talk about tax rates here, as you can see on the screen, but there are two things I want to cover with regard to the tax rates or the tax brackets. The first is where we are today, and I'm not going to read these slides to you. I think everybody's pretty familiar with the progressive tax system, and the more you make, the more you pay. But I did want to draw your attention to two items, and then I'm going to talk about bracket management. If you look at the adjustment between the 12% bracket and the 22% bracket, that's effectively an 83% increase in taxes. When you look at a 10% increase, the 10 to the 20, or the 12 to the 22, off of the 12% base, so that is a ginormous increase in tax burden on a percentage basis. And we see the same thing repeat itself again between the 24 and the 32% bracket, which is about a 33% increase in rates. So as we approach tax planning, the bulk of what we are focused on is bracket management. And so what we're trying to do is manage income between the current year and the couple of years before and after it, to balance that out, to stay out of the higher rates, these higher marginal rates if we can. And when I talked about beginning with the end in mind, there are a number of things that can affect people that will push them around within these rates. Certainly a change in the law is one of them. Doug, do you mind going to the next slide? So this slide shows the change in rates from before 2018. So right now, we are living in probably the lowest tax rate structure we're likely ever going to see in our lifetimes. Without getting into a political debate, as a country, we've written checks we simply can't cash. And one of the ways the government has to raise money is by raising taxes. So if you look back to the 2017 column, you'll see the sort of the old rate structure before the Jobs Act kicked in, which started in 2018. And effectively, the Jobs Act reduced taxes for almost everybody. But because of the way tax laws are passed, they weren't able to make it permanent. They didn't have enough votes for that. So it was a temporary tax law which expires at the end of 25. So beginning in 26, the way you see those colors adjust, you'll see that the higher rates begin at lower levels. And so what this is going to do for somebody whose situation is identical between 25 and 26 is they're simply going to have more money taxed at higher rates. So one of the things that you hear us beating the drum on for people that have come in for their tax planning meetings is managing their income in order to take advantage of these lower brackets while they're available. We'll talk about that more as we go. This is something I think everybody knows, so we don't have to spend time here. The highlight here is that dividends and capital qualified dividends, not all dividends, qualified dividends, which do make up almost all the dividends that we collect at Hengehold Capital, and long-term capital gains are eligible for lower tax rates than ordinary income. It's not exactly half, but it's an easy way to think about it. And there are 3 tiers of that. So some people are in a 0% rate. If their income is on the lower side, 15% is pretty much the traditional rate, and higher income taxpayers wind up in the 20% rate. This is important when we talk about managing somebody's effective tax rate, is to make sure that the income that they're recognizing from ordinary income versus these types of sources is balanced around those rate structures, so that ordinary income fills up the lower brackets and this type of income fills out the balance of the income somebody needs, because the rates top out at relatively low levels. We want to keep the ordinary income out of the higher brackets. Alrighty, Doug. So when the law changes, we talked about the fact that that more income will be taxed at higher rates. The other thing that happens is the standard deduction more or less gets cut in half. So if you'll remember, during presidential elections and things, people would pull a postcard out of their pocket and say, we're going to do our tax returns on a postcard. Well, that never really happened, but taxes did get simpler with regard to individuals, because the standard deduction was increased so high and certain deductions were limited, things like state and local taxes and miscellaneous itemized deductions, that most people, quite frankly, don't itemize anymore, which did simplify the process. When the rules change in 26, we will go back to the old way, and the standard deduction will be cut in half, and it'll be a more complicated tax return filing process again. Now, with regard to whether or not that's going to change, obviously politicians could elect to keep the current system, but again, 2 things are relevant here. One is they need more money, and the second thing is the current tax law will simply expire, and we will automatically revert back to the old system. So in order to keep the current system as is, both Democrats and Republicans would have to agree, and obviously that's not something that they do very well together. Next slide, please. So when we think about taxes, we're always focused on federal taxes, and that is obviously where most of the money is. But it's important to remember that state and local taxes are relevant, and there are some things that are important lately, some of which, interestingly enough, many taxpayers don't know about. One has to do with the working from home, which obviously is becoming more and more prevalent, to the point where some people may have gone to work downtown 5 days a week, and now they go downtown 3 days a week, and they spend the other 2 days working from their home that may be in an unincorporated area, an area that has no local tax whatsoever, or an area that has a lower tax than the city of Cincinnati. If that's the case, then you have the option to file for a refund and claim based on the time that you were in the city versus out of the city. The state and local tax deduction, that SALT tax limitation of $10,000, I think most people for whom that's relevant understand that that's a real problem. I wanted to point out that people who are involved in pass-through entities, the state of Ohio, and I think like 31 states, I think now have this ability to pass that limitation and have the entity pay and submit taxes on the taxpayer's behalf, essentially as a workaround for the $10,000 limit. So if anybody works for a pass-through entity like a partnership or a sub-S corporation, that's something to be aware of. And finally, a thing, this was kind of a big splash last year, but it's not a big dollar amount, but I highlighted it here because I just wanted to draw everybody's attention to it. Scholarship granting organizations are entities that can pay K through 12 organizations that can pay scholarships, give children money for academic tuition. And the state of Ohio, and I know the state of Indiana does as well, has a very similar program that allows you to make a payment to these types of organizations and claim a tax credit. So you can pay up to $750 per person, so $1,500 for a couple, and essentially get that exact amount back, full amount back on your state tax return. So it's not a deduction that's effective at your rate. You get all the money back. So it's essentially free. So if you have an organization that you would like to support, you would want to do your best to make that gift through this channel. Next slide, Doug. So investment income, this is a tax burden that existed before, so it's going to exist after. Basically, higher income people, in addition to all their other taxes, pay almost an additional 4% on investment income, capital gains, dividends, interest, those sorts of things. It's worth planning for with regard to gain recognition and so forth, because as you'll see, there are thresholds. With a little planning, hopefully you can work around that. Also, with this transition period, the sunset of the old rules, we're going to see estate and gift tax. The exclusion now is sky high. So practically nobody, no normal people anyway, see an estate tax. As you can see in that first line, the exclusion for an individual is almost $13 million. The exemption will effectively be cut in half at the end of 25. So people who aren't thinking about these sorts of things in their planning, and attorneys who have been drafting joint trusts, keeping everything in one pot trust, for example, we're going to have to rethink all of that. And people who do have larger estates, in order to capture this larger exclusion, are going to have to prepare from a mindset perspective to potentially making extremely large gifts in December of 25 if Congress doesn't act to keep this exclusion in place. That's probably all I want to do here for now, Doug. So when we talk about managing brackets, there are two main levers that are typically pulled. One is charitable giving, and the other has to do with managing IRA accounts, Roth conversions, things of that nature, and other sources of accelerating income. I just wanted to mention some of the items that we see snags in when we're doing tax returns after the fact for people that have made charitable gifts, and I've highlighted the ones that I wanted to draw attention to. The first one has to be a qualified charity. So if you give money to a GoFundMe effort or something like that, may be a very good cause, but not a deductible contribution. The second highlight there, you need to have contemporaneous written acknowledgement from the charity. What that means is you need to have a letter from the charity that has some special magic words in it saying that you did not receive anything of value, essentially in exchange for your gift. And you have to have that in your you have to physically have that before you file your tax return. In other words, if you get audited, you can't go back and get the letter from the charity, even though everything was perfect. You gave the money to the church, the whole thing. I mean, there's no doubt about it. It's simply not deductible. With regard to IRAs, a lot of our clients use the QCDs. These are qualified charitable donations from their IRAs. It's a great mechanism for two things. One, as we point out here, it reduces your adjusted gross income, which can help with the IRMA taxes. IRMA, as most people know who are getting near that point, are taxes that are imposed. It's effectively a tax. It raises your Medicare premiums is what it does, but essentially it does it for higher income people. And it's measured by your adjusted gross income. The QCD comes out before your AGI is calculated, so it can help you avoid the IRMA tax. The final piece is a donor advised fund. These are becoming more popular, again, especially for people that are coming up on life transition events. So, for example, if somebody is retiring and they're receiving bonuses in the last year, receiving some sort of executive compensation payouts, they can make 20 years worth of charitable contributions in 1 year into a fund that they control, and they can continue then give that money out the way they normally would over the next 20 years, but it accelerates the deduction into the current year, and again manages the current bracket. So the deduction is taken at a much higher marginal tax rate than they will normally be in going forward. Okay, next slide. Okay, my time is just about up here, but what I want to do is just quickly run through the what to do nows. So we've talked about bracket management. Focus on the tax bracket you want to be in, and then do things to manipulate your income accordingly. So pushing bonuses into this year or into next year, if you have that type of flexibility, is a good way to control income. Roth conversions, which we talked about, not forgetting that one of the life events that will drive your income up for people who are who are either already, for people who primarily are turning 73, and if you don't know, the RMD age did change this year from 72 to 73. But people who will be turning 73 sometime in the next several years, when they're forced to take money out of their IRA and recognize that as income, their marginal rate is likely to go higher. So by taking some of that money out through Roth conversions and getting it into a tax-free environment on a planned process, again, that's going back to our rule number one, lowering the lifetime tax liability. That's a very useful strategy. The charitable gifting, donor advised funds, qualified charitable donations, we've just talked about. The QCDs, parenthetically, I mentioned here, also helps with certain states like Ohio, because Ohio starts with your adjusted gross income, and since the QCD comes out before that, if you were to deduct a charitable deduction as an itemized deduction, you get no state benefit from that. But if you take it as a QCD, you also get an Ohio deduction, which is a good benefit. The gain harvesting, loss harvesting, if you're an HCM client, we're doing that for you. And itemized deductions, I put the term bunching behind here because the standard deduction is so high. What often makes sense for people is to push all of their deductions into, say, year one, and have practically no deductions in year 2, and take the standard deduction that year, and then kind of alternate every other year. That'll become a much more common practice again after 2025. Next slide. We touched on the RMDs. Take advantage of the extra year, especially with regard to Roth conversions. If you are working and not fully funding your deductible retirement plans, you certainly want to do that at pretty much all costs, because you're getting, whatever your marginal rate is, you're getting an immediate bonus based on the tax savings. And most people are in a meaningfully lower tax bracket when they retire. So again, you're claiming the deduction at a higher rate, recognizes the income in the future at a lower rate. So you're picking up the time value of money with those tax dollars and paying the tax at a lower rate. Potentially accelerating income into 23, 24, 25 to avoid the higher rates in 26. Again, that's a planning question to see where you're going to stand, but it's a very valid thing. Doing the annual gifting. If you are so inclined to make gifts, don't forget to do that. It's often a year-end discipline for people. The limits I have on the screen here, 17,000 for this year, 18 for next year. And for parents or grandparents who want to pre-fund education plans for children, you can do 5 times these limits into a 529 plan, which is a great way to seed those plans and get money out of your estate as well. This next one is maybe a little bit touchy, but it's an incredibly, it means a lot of money. So for elderly couples, or for couples where one spouse is in poor health and may pass away in the foreseeable future, taking advantage of the lower rates of the married filing joint versus the single tax rate structure is an important tax planning step. This is important for Roth conversions. It's important for income recognition. Taxes are much higher for a single person than they are for a married couple with the same level of income. Next slide. This specifically deals with preparing for 2026. So the Jobs Act expires, as we talked about. Individuals' tax rates are going to be higher. Almost everybody will pay more taxes. The standard deduction is going to be cut in half. The estate tax exemption is going to be cut in half. Taxes are going to increase for most U.S. households. So the call to action here is do active tax planning. So many people just allow the year to close. If you're an HCM client, just call your advisor, set it up. It can be done virtually. You don't even have to come into the office, and it's all included. We're not going to charge you extra for that. So it's so important from a long-term wealth perspective, wealth planning perspective, and it's easy. We are anxious to help with that. And I believe that does it for me.
Yeah, great, Mike. Thank you. A lot of good tax information there, and definitely some good things for clients to think about as we move into year end. Now you may be looking at this slide and thinking, wow, this is kind of a change of topic here. So I think in the 2.5 years that we've done the quote unquote live webinar, this is probably the most straightforward slide we have. But a colleague of mine sent me some interesting information this morning. I won't name him, but you may have seen him on this webinar previously. And it was a piece from Goldman Sachs that actually said that Taylor Swift's concert tour was so large and generated so much revenue that they actually used it as part of their GDP forecast. I believe it was either for the last quarter or the quarter going forward, which is kind of incredible. At any rate, he also suggested that whenever you use or mention Taylor Swift, it automatically adds visibility to your presentation. So here's our slide of Taylor Swift, and now everything that we say after this will be that much clearer. On a more serious note, one of the big topics that we've had over the past year has been whether or not we are going to go into recession. You've probably seen many headlines that have predictions, some of them I think more extreme than others, but If you've heard me speak before, I'm very reluctant to make predictions because most of the time they're incredibly wrong. But just to give you an example of that, here are two headlines over the past year. The one on the left, forecast for U.S. recession within the year hits 100%. This was published on October 17th of 2022. It is now November, 16th today, and we have not entered a recession. So what I will say is, anytime you see any forecast, financial or economic, that has 100% or 0% next to it, immediately ignore it, because there's no certainty in our business. Now you will go to the one to the right, same type of thing. Chances of recession in 2023, as predicted by economists, 96% within the next 12 months and 100% within the next 12 months from the Bloomberg economists. So obviously the debate rages on. Are we going to go into recession? And there were some very adamant economists feeling like this was almost a certainty going into either last year or even going into next year. So, how do we look and think about what that might look like? So there is a gentleman by the name of Michael Hantrowitz. I think that's how you pronounce the name. And he's the chief strategist of Piper Sandler. And he came up with an acronym that's kind of a roadmap for how the economy responds to changes in rates. That acronym is HOPE, H-O-P-E. And really it stands for housing, new orders, profits, and employment. And in his opinion, these four items have demonstrated kind of the highest correlation to being able to judge a recession, but each of them has a specific lag or lead time. So for instance, housing would be the first item that you would see slowing, could happen up to 24 months ahead of the actual recession date. Then you have things like new orders, profits, which is kind of the most coincident. And then you have employment that would be the most lagging indicator. So what I thought we'd do now is actually go through each one of these items and take a look and see where they are right now, and kind of get an idea of, what recession forecast realistically looks like. So we'll start off with housing. You've got two measures of housing activity strength, however you want to call it. The first is the Wells Fargo U.S. housing market index, and that is going to be the purple line. And then you have the very popular Case-Shiller composite 20 home price index on a year-over-year basis. Now, these charts or these two items have been pretty much trading in line, and this only goes back to 2019. Obviously, you can see this big dip in COVID here, but there is a fairly big drop-off here between both of these from 2022 down to the bottom in 2023. And if you think about that, it's not really a big surprise. I mean, interest rates went from, mortgage rates went from the low to mid threes up to a high of almost 8%, which is an incredible move in terms of being able to finance a house and the interest cost that gets added onto a mortgage payment. Now, this year, we've seen a little bit of disagreement between these two. You have the Case-Shiller index kind of turning back up, while you have the Wells Fargo housing market index starting to turn back down. So I think people expected a little bit more pain in the housing market with the interest rate rise that we've seen. But you could certainly argue here that we're maybe starting to see the signs, the beginning signs of weakness in that housing market start to percolate under the surface, so to speak. So I think if I had to put this one as a recessionary or non-recessionary data point, I would probably lean it a little bit more towards the recessionary side right now, but I don't think it's a certainty quite yet. So moving on, we've got new orders. So there's lots of different ways that you can measure new orders, but the most popular one is through the ISM Services New Order Index. And at first glance, this line is very jagged, a lot going on here. But I think the main takeaway here is that during recessions, you see pretty sharp declines in this number. So here's the recession we saw after the tech bust. Here is the recession that we saw during the great financial crisis. Here is the recession that we saw during COVID, if you even want to consider that a recession. And this is where we are right here. So again, you had this kind of spike down lower in 2022, rates are up, market sells off, but now you've had kind of a normalization here. And we're sitting right around 55.5. So we've had a little bit of a rebound here in the new orders index, and it hasn't quite taken that downward trajectory like you would normally see in the beginning of a recession. So again, this one is kind of yet to be determined, but I think this one's showing a little bit more strength or resiliency than what we would see maybe in the housing market. So here's where I think things turn a little bit more optimistic as we look at global earnings growth or profits, so to speak. So you get into recession, in a bad recession, earnings growth can drop as much as 25 or 30%. In a normal recession, it would usually be about 10 to 15. But what we're seeing right now is we had this big recovery in earnings growth, obviously from COVID when companies didn't have any earnings. And then we got the normalization through that throughout 2022 as the market corrected itself. But what we're seeing here is a little bit of a trough. And you're starting to see some of these earnings growth numbers actually accelerating a little bit. So you've got things like emerging markets. It's only up 1%, but that's coming from a pretty big trough. The US here right at 5%. You've got the EFI index, which is basically an international gauge, also showing 8%. So all these are showing positive numbers, but the trend and trajectory you're seeing right now is moving to the upside. So if we were starting to see recessionary signs, you would expect this to maybe start rolling over or moving a little bit lower, but we're kind of seeing the opposite there. We just got through earnings season, and you had a pretty decent quarter for earnings growth, right around 4%. The projection for next year remains around 11 or 12. Now, these growth rates always get revised down, but it's pretty hard to have a recession in an environment where earnings are growing even high single digits. And right now they're projected to grow double digits. So I would say this is probably right now a non-recessionary data point. And then finally, you have employment. There's three data points to look at here. You've got the 4-week moving average of initial claims for unemployment insurance in purple. Again, you can see this moving down pretty substantially coming out of COVID as people started to go back to work, and has really just kind of leveled off here since the beginning of 2022. Then you have the actual U.S. unemployment rate, which was as low as 3.4%. It has bumped up to 3.9%. But one thing to consider is that historically, full employment for an economy was right around 5%. If you look at the old Econ 101 textbooks, that's kind of been the normal rate of employment, so to speak. But if this unemployment rate continues to tick higher along with initial claims, then I think you're getting the beginnings of some concern for the employment market. And then lastly, you've got U.S. total non-farm payrolls here starting to level off a little bit. But again, in a recessionary period, you're going to see that blue line move down. So similar to what we're seeing in the profits, the employment picture isn't really painting a recession is imminent type of environment right now. Now, I will caveat that a lot of these things can change, and they can change fairly quickly, especially on the employment side, since you've got weekly updates, the monthly non-farm payrolls, where you've got profits that are only reported quarterly. But as of now, I think there's some reason here to be somewhat optimistic that this guaranteed recession that was coming can at best be avoided, and at worst maybe pushed out further than some people would have expected. Now, the beginning of this week, we saw a really big rally in the market on the legs of a CPI number that, if you get into the weeds a little bit, there's certainly some points that can be argued there. Nonetheless, it was a number that came in a little bit lower than expectations, and the market was really happy about that. Inflation has been a big topic that we've talked about, I feel like, for the last 2 years now. And one of the interesting observations is that if you go back to the last 3 periods that we've had inflation rates over 5%, that also wasn't coinciding with, I guess you could say, massive amounts of monetary tinkering, so to speak. You have 1975, you have 1980, and then you've got 1990. And these arrows are all pointing to the times where you've had inflation peaking. And then it shows the 2-year forward return of the Wilshire 5000 price index, which is a very comprehensive index of large cap, small cap, mid cap, just a little bit more broad exposure than just the S&P 500. And what you can see is in all of these instances, the 2-year returns going forward are very good. The 74 peak, it's really hard to see down here because the scale is so small, but that was a 48% return. The 2-year from the 1980 peak was a 13.7% return, and then from the 1990 peak, there was a 35.7% return. So in these past cycles where you've had big booms of inflation, the peak in that inflation rate has actually marked kind of the cycle bottom for the market. Now, it's still kind of yet to be determined where we're going to go with this, but what I can tell you is, looking to last year, June was, I believe, the peak in CPI that we've seen so far, right around 9.2%. And the cycle low that we've seen in the market for now was about a month after that, and then you had kind of a retest of that in October. So far, that's lining up pretty well. Doesn't guarantee anything going forward, but it's an interesting observation there. Now, some may ask, okay, what happened in 2000 and 2009? 2009, you barely got inflation over 5%. 2000, it actually didn't get there. And then you had these kind of big market drawdowns along with that, with kind of here you had the tech bubble, and then here you had the great financial crisis. But I've seen a lot of comparisons to the 70s and the other high inflation times about how we might see a kind of a not a double dip, but I guess a double boom in inflation. But it's an interesting observation that the peak in inflation in the past has marked a pretty good time for risk assets. So with that said, obviously we've had a good little run here over the past 2 weeks in the market. Dan, do you think we can see this continuing?
Well, has inflation peaked?
So far it has.
No, if you've been on our webinars, you've probably seen us reference this chart quite a few times. If you haven't, this is the S&P 500 4-year presidential election cycle aggregate. So the blue line here in this chart basically takes all election years, averages them out, and throws them and plots them on the chart. And we right now are the red line, working our way through the election cycle. So this year is the pre-election cycle. This chart is actually back from September. So in that red box there, we're actually a little bit further along. September, October are historically the weakest months of the year. They definitely lived up to their name this year. And the seasonally strong period starts in November and runs through January. And that is pretty much what we're seeing right now. And as you look at the election cycle, election years are actually very strong years for the market. The pre-election cycle is pretty good. You get a good run up at the beginning of the year and then chop at the end of the year, which is essentially what we saw this year. And the fact that we are tracking this seasonality trend pretty closely means that we have the potential that 2024, the election cycle, can actually be pretty solid for equity returns. And now if we go to the next chart, this shows all years. So taking the election seasonality aside, it might be hard to see, but essentially this chart tells us if the S&P 500, when it's up 10% or more through the first 3 quarters of the year, the rest of the year, it is positive 90% of the time. So all these years is a pretty heavy data set. So there's a lot of data that tracks this. 90% of the time is a pretty good hit rate for a positive return for the rest of the year. The average return is actually 3.4%, with the median being 3.7. So those are pretty strong numbers for only 3 months. And if, you know, we're following this data, I mean, it's historical, but we can't really ignore all these data sets telling us that we could absolutely see a year-end rally. Now, we can notice there is, if we go back a little bit, we can notice the down years through there. So there's 3 down years. They're not overly significant. You had 1964 down 0.1%, 10 basis points, 83 down 40 basis points, and what is that, 86 down 1.6%. So while we have strong data saying 90% of the time we're up, and on average we're up 3.4%, we also have data telling us when we're up 10% of the first 3 quarters of the year, the fourth quarter, even if it is down, it's pretty dull and muted. So it definitely shows us that we can definitely continue to rally going into year end. So one of the more rare signals that has recently fired is called a Zweig breadth thrust. This is something that gets our attention whenever we see this fire. It's a little nuanced and in the weeds on what it is. It's essentially showing all the issuers on the total market and the amount of advancers versus the amount of decliners. And if the market, or if the advancers go from only 40% of the market to 65% of the market in one day, this Zweig breadth thrust triggers, and we get some really interesting numbers when this thrust triggers. So we actually got one on November 3rd. And as you can see on this chart, when we get breadth thrust, again, there's only been 12 occasions since 1962. The 250-day percent change, if you can hover over that, Doug, those numbers are pretty substantial. The average win rate after we get one of these large market breadth heavy buying thrusts is an average of 24.32% over the next year. And this indicator, this thrust that happened, we have 12 instances. It has been positive 1 year out 100% of the time. So even on the years, so 2015, 2013, some of the lower numbers, you're still getting 9.14%, still getting 6.97%. So those are healthy numbers. But if we really get the follow through on these weak breadth thrusts, you're looking at numbers upwards of 20%. So that is something that's definitely piqued our interest, and something that's very rare, and it carries a lot of weight. So I really didn't even plan on talking about small caps for this specific webinar, but this week we just saw a move where small caps rallied 5.49% in one day. So I figured we should probably talk about it a little bit. So this was on the CPI reading. So CPI came in a little soft, and treasury rates across the board fell pretty substantially. And with small caps being heavily exposed to financials and regional banks, which higher rates really put pressure on those regional banks, when you get a softer inflation print, when you get rates falling, small caps can really rip. More fuel to the fire is valuation. So this chart essentially shows you valuation on the S&P 600, which is small caps, more quality small caps, and the S&P 500. So when we are looking at a valley on this chart, that means that small caps are very undervalued compared to the S&P 500. When we're seeing a mountain above the line, that's telling us essentially that small caps are pretty overvalued in relation to the S&P 500. So right now we're looking at small caps being 5 times cheaper on a relative basis to the S&P 500. So when you get soft inflation prints, when you get rates falling across the board, you're going to see the regional banks rally, and you're going to see small caps follow as well. small caps. We have small caps in our portfolio. We are not adding at this point just because we need to see more out of them. But from a valuation perspective, I had to touch on it because we saw this insane rally and I wanted to talk about it a little bit. So where are we at now? So we've had a roughly 10% rally over the last, couple weeks. A lot of people might say, the market's getting a little greedy. This might be a blow off top. It might be overbought. But if we check in on sentiment, this essentially is a sentiment chart that shows fund managers. So it's the fund manager survey from Bank of America, and it checks institutional investors where their sentiment lies, and it takes their cash level, their equity allocation, and their growth expectations into account. So as you can see, we had a sentiment low late 2022, early 2023, and sentiment has definitely risen. People are a little more optimistic, but we are absolutely nowhere close to the greed territory and the hyper sentiment territory. So from a sentiment perspective, we're not in a point where we would be worried about over exuberant investors and fund managers. So there's definitely a little bit more room from a sentiment perspective for this rally to continue going. And then I feel like I want to be like Lee Corso right now and say not so fast. Right? So there's definitely still risks in the market. And one of the main risks, the head of the fund manager survey, the main risk that everyone's worried about is geopolitics. You've had Israel, Palestine, you still have UK and Russia, China and the US. There's a lot of things that fund managers are worried about because, if you turn on the news, it feels like we're in a pressure cooker right now, just waiting for something to break. And that is not something that we can ignore. It's not something that the global fund managers are ignoring. It's definitely something to watch. But you also have to notice that the second largest concern is 25% of fund managers still worried about high inflation, keeping the central banks hawkish, so higher for longer. And 23% are still worried about that global recession hard landing. I think I saw a survey that Goldman Sachs came out saying they're lowering the recession risk to 25%. But I've seen others saying recession risks are still at 50%, 60%. So it's definitely not 100%. It's never 100%. And it's definitely a cause of concern. We're going to have to watch this very closely. From a macro perspective, I would say we're absolutely not out of the woods yet. But from a price perspective, from a technical perspective, from a health of the market perspective, there's definitely some fuel to have us rallying into year end and maybe even first quarter of 2024.
Thanks, Dan. So kind of some quick summary of positioning and maybe some recent activity that we've had. So we've had some recent increases to both equities and to our bond duration. Some of that has been from the cash allocations that we've had. Others have been from some of the, more tactical fixed income portfolios or strategies that we've got. But we have made small increases to both of those positions here over the past few weeks. We still hold large cash balances, large relative to what we would normally have. And we're still comfortable with that at this point. Money markets paying 5.25% are still attractive assets to hold. I think that the time to maybe look at that and start to be concerned is if the Fed were to change language and actually cut rates, then you'd see those money market rates start to move lower. But I don't think we're close to that event quite yet. Obviously, the economic path is going to determine our next moves. We've talked a lot about the possibility of recession, during this presentation, That's kind of our number one, at least in my mind, our number one concern right now, as to what could significantly change the path of the market. And then finally, Mike talked about taxes at the beginning. We're really trying to push any taxable gains into 2024. So if for any reason we were to do any rebalancing or profit taking before year end, we would try our best to match that up with other losses in the portfolio, or use areas that don't have as large a gain or have more favorable gain status. For instance, large or long-term gain versus short-term gain. So we'll do our best to push that out to next year, but unfortunately, we don't necessarily control what the market does, so we may have to act before then. So questions, we've got a few here. One, I guess, related directly to recession. If we did see a recession coming, would we change the portfolio allocation? I would say yes, absolutely we would. I think we would look at changing both the mix of equity to fixed income, and then also the mix of what is inside of both the stock and the bond portfolios. Specifically in the stock side, you'd want to own more defensive names while also reducing some of the higher beta plays. I know Dan just talked about small caps. Small caps historically struggle in a recessionary environment, but we would certainly change the makeup there. And then we talked a lot about duration in the past. We would certainly look to possibly add duration in an environment like that, assuming that rates are going to come down in response to slowing growth. So anybody have anything to add on that?
Not here. No.
Okay.
Nope.
Okay. One other question is when do you think the market will start being concerned about the election? I guess I don't know how to interpret that question. When I think the market's always concerned about it. When it might become more of a focus. I think I don't even know when the first debates or presidential polls come out. I know there's some that have already been released, but we're way into the future and we don't even really know who the nominees are yet. So I think until that type of thing comes into focus, I'm not sure that that's on the market's radar quite yet. But that's kind of the best way I can think about that. Mike, Dan, do you have any thoughts on that?
I do. I mean, just from research or historical observations that I've read, and although it feels like there have been lots of elections, if you think of relatively modern times, we just don't have that many observations. But typically the election year, as Doug pointed out earlier, is a good year. Normally, once I'll say polling, but there we are. Once polling and things indicates who the likely winner will be, that's when the market starts to rally. So it's an old cliche, but the market abhors uncertainty. So as long as it's nip and tuck, I think the chances of the market really taking off out of that, at least in the sense of worrying about the president, is unlikely. The other thing is, it's not so relevant that the market gets the president at once. In other words, the tax cutter or whatever the case may be. It really only cares that the uncertainty is gone, and it tends to rally from that point forward. In other words, it rallies Democrat, Republican, and so forth once it seems pretty clear what the answer is going to be.
Well, I don't see any more questions. So, Mike, if you can go ahead and take us out.
All righty. Again, I want to thank everybody for participating today. The call to action is the same. If you've not yet scheduled a tax planning meeting and you have any interest at all, especially if you are coming up, say, in the next 5 to 10 years on an event, a life event financially, whether it be retirement or beginning required minimum distributions, or whatever the case may be, or just simply wanting to get a good idea of what the current tax year looks like, please reach out to your advisor. As I said, there's no cost to that. It's an important part of what we do, and we want you to participate in that if you have any interest at all. And as always, if you know somebody who might benefit from the types of things that we do, please connect us. There are no strings involved there whatsoever. If we can help somebody, we will. Schedule-wise, we will be taking December off with our normally monthly video, but we'll be taking the holidays off, and we'll be starting again in January. Of course, if news breaks, you'll get an alert, and we'll be right back here to talk about that. So again, thanks for participating, and we wish everybody here at HCM wishes everybody a happy Thanksgiving and a happy holidays. Merry Christmas, everybody. Thanks.